Futures are trading lower this morning as investors brace for another volatile week as tensions in Russia and Ukraine remain high. The Dow dropping more than 200 points on Friday. That was on the heels of its worst day of the year on Thursday. Last week's worst performing sectors: energy, communications services, and financials. Joining me now through the cycle, President John Zlonsky, and joining the conversation all morning long, Monica Crowley and Ken Mahoney. John, what are you expecting in the weeks ahead? It's not just about Russia and Vladimir Putin.
It's very much going to be about the future direction of price inflation. I do not believe that inflation is going to subside anytime soon. It's going to remain a problem. We are also at a turning point for the U.S. economy, in that the U.S. economy now has to wean itself off of, break free of the record fiscal and monetary stimulus that it's received since COVID. We've had the largest dosage of such stimulus since the Second World War. Not surprising we have price inflation, and I think the big worry eventually will be whether or not the Fed efforts to tame inflation push the U.S. economy into a recession.
And John, we're moving from goods inflation into services inflation, are we not? I was just looking
Yes, we are.
Watching the Daytona 500 yesterday, sold out crowd. The infield jammed with people. I haven't seen crowds like that in years at Daytona. So there is pent-up demand, but also that fuels goods and service inflation.
Yeah, it's not only sporting events. It's also going to be it's going to be housing, housing services. Roughly 1/3 of the CPI consists of what's called shelter cost inflation, excluding energy. And I expect that that's going to move sharply higher given the jump in home prices and, more importantly, surging rents charged for apartments and rental housing.
Ken Mahoney, jump in.
So, look, we know over time the recessions are usually not caused by inventory adjustments. Recessions are not caused by a slowdown in the economy. Most recessions are caused by the Fed, right? So this is what they're concerned with. Is there any way to kind of navigate this where you can actually do two things, somehow stifle inflation without having this hard landing that we continue to go through because of Fed's tightening? I mean, is there some middle ground here?
Here's the problem, Ken. This is the first time that in years since the 1970s that the Fed has to lower a rate of inflation that's well above 5%. It was 7.5% in the month of January. And what we found from the 70s is that whenever you try to control historically rapid rates of inflation, unfortunately, recessions result because of the Fed overshooting with interest rates, and also because I wouldn't be surprised if this 10-year Treasury bond yield takes off at some point in this year, begins to go well above 2.5%, approach 3%, and that does a lot of damage to credit-sensitive spending in areas like housing. And by the way, there is a housing sector stock price index that is down by 16% for the year to date, despite what remain pretty strong home sales.
John, because we keep talking about the 40-year high in inflation going back to 1982, but back in 1982, you could earn 8 to 10% in a money market account, in a money market fund. So today, in terms of the inflationary impact on people who are trying to be responsible and conservative with their money and be safe, they're the ones, they are losing 7% with their money parked in a money market. They're being forced to essentially gamble on super risky assets just to try and keep up with inflation. And when I mean gamble, I mean put money, you're losing 7% in a safe investment. So you have to take risk, meaning possibly losing 20%, 30%, 40%, even 50% of your money just to keep up with inflation. That's how much this Fed and this government has screwed over responsible people now. It's horrifying.
You're exactly right. the Fed has pushed a lot of people well out onto the risk frontier. They don't realize how much they're assuming in terms of risk. I came across this forecast from J.P. Morgan that we're going to be looking at a run-up by the federal funds rate from what is now less than 1/4% to 2 3/8% 1 year hence. Now, eventually the small saver benefits, but such a steep increase by short-term interest rates is likely to push the stock market significantly lower. It's going to do some damage to other financial assets like Bitcoin. And you're bringing up a great point, Dagan, in that the situation we have today is unprecedented. Never before have we had like a 0%, almost 0% Fed funds rate in the context of 7.5% inflation.
Right.
And it's absolutely crazy to think a 10-year Treasury yield right now is just under 2%, given 7.5% inflation.
So when people come on and say, oh, I went back and looked at the last rate increase cycles, and here's what the stock market did, and I'm like, we've never seen this before. This is, to use your word, this is unprecedented. The Federal Reserve doesn't know what it's doing, so don't tell me they did. They don't know what they're doing. They don't know how to unwind any of this. Look what they've done to people who just want to save some money and not take risk with it. They have been trampled by these policymakers on the fiscal side and the monetary policy side. John Lonsky.
Right. This isn't the time for the Federal Reserve to become involved with climate change. Believe me, they have enough difficulty trying to control price inflation and provide a decent return to investors on bank deposits.
But that's who Biden and co nominate, right?
That's
Once
who they
again,
did, and that's why you have a very messed up economic policy framework right now, exactly when we are getting rid of the largest amounts of monetary and fiscal stimulus since the Second World War for 2022. Hold on to your seats. Watch out. Who knows how this plays out? Unfortunately, it's probably not going to end nicely.
John Lonsky, thank you for being here always, sir. Great to see you. Coming up, a last